You're listening to Real Estate Radio Washington, D.C. Metro on the Big Talker 1580. Now, live in studio, your host, local real estate expert, Ryan Sloper.
Welcome, Washington, D.C. Metro, to Real Estate Radio, the most important hour of radio every Monday on 1580 AM, the Big Talker. Thank you for joining me this afternoon. For those of you who don't know, Real Estate Radio is a show dedicated to building the Washington, D.C. metro housing and credit markets. Within every market, there are solutions as well as tremendous opportunities, and you just need some trusted advice. That's my message, and I'll be delivering it to you every Monday from 2 to 3 p.m. right here on 1580, the Big Talker. Joining me on our panel today is Louis Cammarosano, the general manager of HomeGain. Louis is consistently an industry leader and has been ranked in Inman News top 100 most influential leaders in the technology sector for numerous years straight. Louis, you there?
I am here, Ryan. How are you today?
I am doing well. How was your weekend?
It was good. Yours?
It was excellent. Obviously, you know that I had a newborn as of a week and a half ago, so spent most of my time, being sleep deprived.
Oh, congratulations, Ryan.
I appreciate it. I mean, it's definitely one of the greatest things that's ever happened to me. And, outside of the sleep deprivation, it's been completely an awesome experience.
What's funny about that is the baby always does sleep.
Isn't that interesting? And they always say that, to sleep while the baby's sleeping.
Right.
And there is no way in the world that happens.
No.
I thought about it the other day. I was like, well, he just went to sleep. Let me lay my head down. And then I realized I had 20 other things that I had to get done.
And the baby doesn't have to do anything except eat and sleep.
Yep, it's
diaper change.
It's a wonderful life, and it's funny. Like when you're growing up, and your parents always tell you, don't rush it. You don't want to get old too quick, and it's all too true because you sit there and you look at the baby and how innocent and how great they have it. It's like you just want to go back to those and sleep like they did.
When you feel like it.
Exactly. Well, we got a great show lined up, a lot of stuff going on. I know the NCAA tournament wound down last week with UConn winning it all. We had the baseball season kicking off. We had the potential government D.C. shutdown that was supposed to take place that I knew was not going to happen. We have the tips for buying short sales and foreclosures. Also coming up a little bit later, are you having trouble obtaining a mortgage? Well, we want to make sure that you guys can get qualified. We're going to give you some of the top tips to prevent yourself from, not being or being rejected from obtaining a mortgage. And also coming up later, don't forget that there's 3 weeks left to get the $8,000 cash back with the federal homebuyer tax credit program for certain members of the government and qualified military personnel. And that's coming up all later. And another reminder before we get started that if you have any questions regarding any topics we cover today, just call the off-air number. It's 877-245-2030. That's 877-245-2030. And I will personally advise you, point you in the right direction for somebody that can help you out. Now it's time for the business insights of last week, where we recap all of the important credit and real estate-related events of last week. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to homegain.com and see what I'm talking about today. All you need to do is type in your home address, and you will get an instant free estimate of your home's value online. And it's a great way to monitor your home value for free. I highly advise you check it out today. It's homegain.com. Now, on Monday, bonds were on a good run since last week's jobs numbers continue to show improvement. And it's been kind of a tumultuous last week or so. The rates have been kind of moving up or close to more towards the 5% range. And Louis, I know we discussed this. It was only a matter of time before they started to tick back up. I know I looked today, and they've kind of gained some ground back a little bit this morning. But it seems like the stock market's been rallying over the last week. I want to say it's up over, 12,400 or something like that right now. And it just, I've been telling people for a long time now that the run is, I think, somewhat over, and I don't think that we're going to tip back down into that 4.5% range anytime in the foreseeable future. What do you think, Louis?
You're going to see more and more inflation numbers come across the board where finally the Federal Reserve, I think they're the only ones who don't see the inflation, will take notice. And there's already, I think, at the Fed, about half of the members there are kind of hawkish and looking to nip inflation in the bud and start raising interest rates. But it seems that Bernanke made his recent statement that inflation is transitory, if that, and if it gets out of hand, he can stop it. I don't think anyone's going to believe that when you start to see the official numbers, even the official numbers coming out and, hitting past their, I think it's a 2% target rate. Once that happens, it's probably already be too late, and then interest rates really will go up pretty quickly. I think you mentioned they go up fast, they come down slow. They're going to have to go up fast. Also, what's happening is Europe last week raised their rate, I think 0.25%, not much. China's been raising their rates. The issue there, they're doing it to lower inflationary pressures, but what happens is dollars end up following that, because if you can get a high rate of return in another country with a higher interest rate, the money goes there and, in fact, has a reverse effect, because then you get inflation in those countries. As I've been mentioning, at some point, all of it's going to come back to us.
Yep.
And when it does, the interest rates are going to have to go up, and the low-priced mortgages are going to be a thing of history.
Absolutely. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano, General Manager of HomeGain. Interesting that you bring up the Federal Reserve, because I was just reading an article this morning, Louis, and you're going to get a crack out of this. It was from Janet Yellen, the Fed Vice Chair, and saying the same thing, that inflation is transitory and it will not impede the economic recovery. And I want to read this, a few excerpts anyway. The first excerpt says that the recent run-up in commodity prices is likely to weigh somewhat on consumer spending in coming months, because it puts a painful squeeze on the pocketbooks of American households. In particular, higher oil prices lower American income overall, because the United States is a major oil importer, and hence much of the proceeds are transferred abroad. Monetary policy cannot directly alter this transfer of income abroad. Thus, an increase in the price of crude oil acts like a tax on U.S. households, and like other taxes, tends to have a dampening effect on consumer spending. So that was the first little excerpt, okay? Now, the last part of it is kind of like the conclusion. In summary, the surge in commodity prices over the past year appears to be largely attributable to a combination of rising global demand and disruptions in global supply. These developments seem unlikely to have a persistent effect on consumer inflation or to derail the economic recovery, and hence do not, in my view, warrant any substantial shift in the stance of monetary policy. It's kind of like she's acknowledging wholeheartedly that there is going to be a major problem with consumer spending, and then on the other hand, basically saying that, the economic recovery is not going to wane.
And also, somehow, she's saying that the Fed has nothing to do with it. They come up with all these reasons why commodity prices are up. There was a drought in this country,
right,
a drought in that country. One of them I heard was emerging market countries are having more sophisticated diets, and that's putting a push on commodity prices. What they're not actually admitting is that they're putting more dollars in circulation. All commodities are traded on the international market with dollars. There's more dollars trading, chasing the same amount of commodities, and there may be increased demand, but there's not a 200, 300% increase in demand in cotton and corn, and there is no drought that's causing silver and gold to rise.
I know.
They just don't want to admit that it is actually voodoo economics to think that you can print money and think it's not going to have any impact. The only impact it's going to have is beneficial, that somehow it's not going to cause inflation.
Yeah, and I think Sam and I were discussing earlier, it's kind of like, that mentality that they don't want to push out there that it's going to affect the economy by any means, and it's like, they're trying to keep consumer sentiment somewhat stable by making these remarks that are just kind of doublespeak all over the place.
It's like it's all good. That's what they're saying.
Right.
That somehow consumer confidence is the most important thing, and they don't want to damage that, because then people won't borrow more money to buy stuff they don't need.
Absolutely. And what this means to the buyers out there that are currently looking for a home, and what this means for sellers, inflation is the arch enemy of mortgage-backed securities. So we know what's going on. It's only a matter of time before the markets completely catch up on this and rates rise very quickly. When I say quickly, it could literally be a half a point in a day. It's just we don't know what that day is going to be, and we don't know eventually when the market's going to, take all these things into consideration.
They just keep pushing the spring down.
Yes.
But the longer they wait, the worse it's going to be.
Absolutely. And, on Tuesday was a pretty momentous day when it came to loan officer compensation, and I don't know if you've heard too much about that. I know I sent you a couple papers on basically the Fed imposed a rule that's going to regulate the way loan officers are compensated. And I want to really bring this to light because this affects so many people out there that are shopping for a mortgage right now. They don't really understand that this could ultimately lead to more costly loans and higher interest rates. So not only do you have a coupling of inflation, which is going to enforce mortgage rates up, now you have this new mortgage compensation plans that are out there for most loan officers, which are going to force the prices of mortgages even higher. And what the compensation plan basically says is that every loan officer, they have to have a consistent compensation for every single loan that they do. So let's say that, Lewis, you took out a loan and it was $100,000. The borrower is going, or the loan officer rather, is going to make the same amount of money essentially off of you as he would make off of a loan for $500,000. They base the loan officer's, income off of loan volume and not any specific loan term associated with that loan. So, i.e., interest rates. You know what I mean? Where before, a loan officer can be compensated based on an interest rate. So you would typically hear if you're getting charged a higher interest rate, you would assume that the broker or mortgage lender is making more money. That's not the case anymore. So who's making that money is the question that everybody has been asking me. Well, it's the banks. Now the loan officers are making less money, and the banks are now hoarding even more money as if they needed any more to begin with.
Well, they do need it. They need it to bolster their balance sheets, but they don't make any money now making these loans, so they're better off taking the free money from the Fed, parking it back in treasuries, and getting paid interest on that. And then most of them have trading operations where that's where they make the bulk of their money, so they employ their capital there where they can leverage it. Making these loans doesn't make them much money, and I think I sent to you just recently, now the regulators are looking to propose a 20% down payment. So it's only going to get worse for the home buyer. It's going to be harder to come by credit. You're going to have to put more money down. It's really a good time now, while you can, to get a low-interest loan if you can get it. Because, as we've been mentioning for the past couple of months, if you buy a house now and it's a good price, one where if you had to rent it out, you'd meet your mortgage payments, and you can get access to that loan at a rate lower than the inflation rate is going to be, the bank is basically paying you to take their money. And I think that's why they're also reluctant to make a lot of loans right now, because when the interest rates go higher, all those loans become losers.
Absolutely. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano, General Manager of HomeGain. And Louis, I do think that, loans are going to become tougher and tougher down the road. And I did read that article that you had sent me on federal regulators proposing a 20% down payment for best home mortgages. And, most of the reason why they're not making as much money on these loans, they're still making money, Louis. Don't get me wrong. They're definitely making money. It's just not as much as they were used to making.
And they're able to make money in other areas, and they're also able to make it risk-free by just keeping the money on deposit with the Federal Reserve.
Right. But what's comical about this article is, they're trying to figure out what they're going to do with Fannie and Freddie Mac. They obviously are trying to wind this down, and they really want to make, the loans that are associated with Fannie and Freddie like 20% down programs where they know most people aren't going to, they're not going to qualify for that. So They're hoping to bring in more interest from the private sector again to get people lending again outside of the government. Well,
they'll have to lend based on prudent lending requirements, not based on the government requirements, which is basically social policy rather than economic policy, which is lend to anybody because we want everybody to have a home.
Yeah, well, you see, being in the finance industry, I think it's so interesting because I get to see hands-on what goes on. And, most of the time the problem has never been with the down payment. It's never been the down payment. Because when you do have a loan, you put 20% down, you just don't have to get mortgage insurance companies involved. Okay, which that is like a second underwriting process that you have to go through. So there's overlays that cause problems and everything else. If you put 20% down, the investor basically feels like he's got, a stake in that property and that even if you default, he can take it back. But, by doing that, it's pretty ridiculous because, 99% of the people aren't going to qualify for that loan. And the alternative, the government owns Fannie and Freddie. So if they don't get that type of loan, where are they going to go? They're going to get an FHA loan, which is a 3.5% down payment, basically insured by who? The government.
Same thing.
It's the same exact thing. So why are they even worried about this in Congress? Why don't they just say, do away with Fannie and Freddie and be done with it? That's what I don't understand. They're spending all this time and money and effort saying, oh, let's try to make the best mortgage possible for people that put 20% down. They can get the best rate. It's a waste of time.
It's probably because Fannie and Freddie have even more losses than we're aware of, and they don't want to shut that down and be exposed. They're kicking that can down the road, too, I think.
Yeah, inevitably they're going to have a lot of money to make up, and we know that there's still, millions of foreclosures that still have to happen or take place within the next 2 years. at some point that's going to happen. But, I just thought it was pretty interesting the way that article was laid out. And I do feel like, FHA is always going to be around. And if you've been noticing, what they've been doing is for you buyers out there, this is another reason to want to apply for a loan now, is that they plan on raising the upfront mortgage insurance, or actually the monthly mortgage insurance premium up even further than where it is at now. And they're going to continue raising those insurance premiums until they really feel like they've got a good net profit. I think they netted like $3 billion FHA did last year in profit. So they're making quite a bit of money there, but yet they're still raising premiums on the other side. So it's pretty interesting. If you're out there right now and you're looking for a mortgage or just looking for some good information and you're just starting your search and you want to consider buying versus renting, please reach out to us at 877-245-2030. Rates are pretty much at very generous lows right now and unlikely to continue at that pace. On last Wednesday, the Dow continued its run as stocks finished in the green. The market had just been on fire last week going into Wednesday. On Thursday, the jobless claims moved lower, which was, I guess, a good sign for the recovering economy. That's, of course, what the Fed and everybody else will say. Good for housing if jobless claims were lower as well. But keep in mind that this will cause mortgage rates to rise, just like any good news. So any good news in the stock market is, once again, making mortgage rates worse. And on Friday was the big day, Lewis, where the government in D.C. was poised for a shutdown, okay? Had basically the whole country up in arms, like this can't happen, there's no way, how is this, what's going on? Never for a second did I ever think that this was going to happen. What did you think? I knew it wasn't going to happen.
Well, I knew it wasn't happen because the people that were going to make it happen would be the Republicans, but Boehner said he had no interest in doing that. What people don't understand, though, is when the government shuts down, traditionally, or historically, not traditionally, is that most of your basic services remain in place. The FBI still works, the Social Security checks still go out, the post office works. What gets shut down are the non-essential services. I was kind of hoping to see what would happen because the things that get shut down are things like the IRS, the Department of Energy, the Department of Education. Those workers then go home, but they still get paid.
Right.
They're on furlough under the law. So it would just be interesting to see what real value people get out of those services versus the essential services. And I think the way they fear-mongered the whole thing in that, people wouldn't get their checks, kids wouldn't get fed, old people would have the plugs pulled on their medicine. None of that is true. So it was really kind of a farce that this whole thing played out over basically probably less than 0.5% of the budget. They were arguing over $10, $15 billion.
Right.
And there's a $1.2 or $3 trillion deficit, and we owe $14 trillion. So no real progress was made. Only thing that really happened was it sets the tone that somehow Congress has to look at spending cuts, not expanding as it has for the last 100 years.
But it was interesting to me too. They said that like the last pressing issue down the wire was more of a social issue for abortions for low income families. Yeah. Like this is a budget issue, not a social issue, and that's exactly what they were making it.
Well, that's politics. If they realize that they can win points on either side, that's what they're going to do. I just thought it was interesting. How much money do you think that was actually spent preparing for a shutdown? I was able to find memos that are 60, 80 pages long talking about what you do in case of a shutdown. And what's funny is the money that they saved, I heard that the government spent $56 billion last week, and, they're going to save $38 billion, so they didn't save anything.
Right, exactly.
They just create a lot of maneuvering on both sides and the president trying to win political points. The real issue is that the people are the losers because no one won. They may have won in terms of their political standing, but nothing changed. The government wasn't shut down, and the money's still being spent. Yep. And they had some discussions and debates over some social issues, which they should be having all the time anyway. Right. Much of the same. It's just the same old. But on to the next thing. You actually were interviewed by the Chicago Tribune on the disconnect between buyers and sellers. And I think this is an interesting note because a lot of just kind of talking with a lot of people, potential people that are buying and selling their homes lately and kind of trying to get a feel. And obviously all real estate markets are local and very hyper-local at the moment. Obviously, you're out in the West Coast. I'm here in the D.C. metro area, and things are,
I mean, they're actually kind of booming around here, which when I tell people that, they're kind of like looking at me like I'm crazy. Obviously, you and I have had some discussions about that. But for you out there that are buying your home, I'm curious to know if you actually think that your home is actually worth more than what it would actually be listed at by a real estate agent. And they had asked you that question, right, Louis? So have the sellers seen the light and started pricing their homes realistically from the get-go?
No, they haven't. And I based that opinion on the Home Gain first quarter 2011 survey where we asked homeowners and real estate agents what their impressions are of home prices. And the real reason for it is, if you think about home buyers and home sellers, they're not really in the market more than probably every few years, if that. Some people are first-time home buyers, so they don't know what a home is going to cost. And then a home seller, they just know what they paid for it, and they know how much they owe on it. So generally, they go in, the realtor meets with them, and they say, I need to get $550, and the realtor says $500. And they argue, and then they set the price lower than $500, and then it sells for lower than the price they listed at. That we see all the time.
Right.
And that's the disconnect that sellers need or want or still believe that their home is worth more for whatever reason. And then buyers, they don't know anything. They're not buying houses. All they hear is that there's foreclosures on every corner and that there's bargains to be had. So that disconnect exists and persists and is really also preventing, some of the inventory from being worked off. But the buyers have the upper hand.
Yeah.
Because the momentum has been the prices are going down, and there's really nothing to indicate that they should go up other than in certain markets. Remember, these are national statistics,
right?
And every area is different. There are bargains in some areas, and there are areas that are still overpriced.
Yeah, I actually have in front of me the S&P Case-Shiller. Their home price index showed that 18 of the 20 cities they monitor had year-over-year depreciation. San Diego and Washington, D.C. were the only two markets to record appreciation. San Diego was up a scant 0.1%, while D.C. posted a healthier 3.6 annual growth rate. So, yeah, it is interesting to know. Even still, I do think that, your survey sheds a very good light on where buyers and sellers think that that homes should be priced at.
But that's generally probably in any market what the buyer and seller dynamic is.
Right.
The buyers want to bargain and sellers want to get more.
Yep.
They start off high and they end up lower. Now, I think, though, there was a disconnect. There was a time period in the mid-2000s when home buyers expected to pay more because they were just rocketing up. But normally, if you go through history of the last 100 years, home prices generally don't have that type of appreciation.
Right.
They generally are on a slow burn, rising in conjunction with inflation, employment, and other standard economic figures. It was really, at the beginning of the 2000s where they ratcheted up kind of in a hockey stick, and that changed the entire dynamic with all the new loan products and low interest rates. But I think we're going to eventually return to, buyers wanting to pay less and sellers wanting to get more, but they'll be closer on price.
Yeah. 877-245-2030, 877-245-2030. We're discussing the disconnect between buyers and sellers. So my best advice then would be to make sure that you're working with an agent that really knows the local area, and to make sure that agent has a good knowledge of what the market's like outside of the short sales and foreclosures, to kind of give that, the buyer or seller the knowledge that they need to make a good decision coming to contract. Wouldn't you agree?
You have to get a quality real estate agent, realtor, who knows your local market, knows how to price a home, knows how to get that price. And if you're a buyer, it's now important. It used to be a little less important to have a quality realtor who represents you. But now with short sales and foreclosure, you absolutely must have good representation. And, we did that FSBO versus realtor survey where consumers were much happier using a qualified realtor to help them in the transaction, and they scored a 50% better chance of getting their home sold if they did use one. And then of the FSBO, people who went FSBO, 25% of them actually went and had to hire a realtor to get the job done. So now more than ever, with the complexity on the buyer side and then just knowing how to get a home sold on the seller side, you really do need a qualified realtor.
Yeah, especially, and there's so many different niche markets, like you said, with foreclosures and short sales and regular sales and working with a buyer versus sellers. I mean, there is so many intricacies right now that there wasn't 10 years ago.
And they know the market.
Yep.
Whereas the buyer and the seller generally have no idea.
Absolutely.
The realtors in the market every day buying and selling homes, getting impressions and market data.
Yeah, and when we come back, we're going to discuss the tips for buying short sales and foreclosures to help you guys get a handle on that. Stay right there.